Yeah, I mean, it's interesting, right? Like COVID totally shook up a lot of different things, but one thing being the global supply chain. So the definition of inflation is too much money chasing too few goods, right?
Right.
So we saw the supply chain, basically a massive glut in the supply chain. So
Right.
factories shut down and nobody was really producing as much as they were normally before COVID.
Right.
And there just wasn't enough goods for people to buy, but people had a lot of money because there was a bunch of cash being injected into the market, right?
Correct.
Central banks were pumping out money and giving like CERB benefits to people. So that's
And governments were, right?
yeah, absolutely. So that's what caused prices of goods and services to go up the way that they did.
Right.
Now, to combat that, the central banks have raised interest rates, and that's
Right.
what we saw happen last year and well into this year. So that's hopefully going to bring inflation down, and we're starting to see that happen, right?
Right.
But it's an interesting balancing act that the central banks have to play, right? Because as a result of raising interest rates too quickly, they cause things like the Silicon Valley Bank fiasco, right?
Yeah.
And well, they caused it. I guess they would have caused it. But basically, with the Silicon Valley Bank, what happened was the bank was taking depositors' money and they were buying assets with it. Okay,
Yeah.
so
Bonds.
exactly. So 10-year Treasury bonds, because
Yeah.
those were paying the highest interest rate.
Fixed mortgage rates.
Yep, exactly. So, but the problem was they were buying long-term assets to cover short-term liabilities, because a deposit is a short-term liability for a bank,
Yeah.
right? And when interest rates went up as much as they did last year, it devalued these bonds, right?
Yeah.
So when all these people said they wanted their money out of the bank had to sell these long-term bonds that were worth maybe, three-quarters of what they were originally.
Yeah.
And that's what caused the problem, right?
But and I sometimes look at that as well and saying, is that not very elementary? How could a bank like that
It
ever
totally
do
is.
that? Because
Yeah.
any financial advisor like
Yeah.
you would have not advised me to take that money and put it into bonds.
Well, exactly, right. And it's interesting. We have a much different system here in Canada. I think
Yeah.
we're quite insulated to this, but
Yeah.
how were the people running these banks allowed to take that money and invest in something like that?
Exactly.
The problem with these bonds is they don't get marked to market every day, it's called, so valued every day. So they show on the books as being worth, let's call it $100 million or $100 billion, but they're actually only worth $75 billion.
Yeah.
And when they originally bought them, they were worth 100, but because interest rates had gone up, they were worth less, right?